Boom. We are alive, ladies and gentlemen. Thank you for joining us today. This is Tio in the Arcane Bear. Pretty exciting stuff. I want to go over some psychological things today. And we're going to do that by taking a look directly at Bitcoin to begin with. So here on the 6 hour is the same Bitcoin chart we have been following, well, it's about a month now. So you just be a bit more approximate. Around 38 days. Throughout this process, the entire crypto sector has become aware of Wyckoff analysis, which is great. We always love when people learn more. It's one of the reasons why we do this. We've been going over the Wyckoff phases since March, April, May of 2020 when the Bitcoin bull market started. My favorite part about this is the psychological understanding. So even though we're looking on the 6 hour, what we would like to do for just a moment is go back to where we started and take a look at Bitcoin on the daily, because the spring, which is a moment that a lot of people are talking about right now, is actually usually a much bigger endeavor. So one of the really unique aspects about this pandemic is it taught us a lot. It taught me a lot, and I hope it taught a lot of you some very interesting, important aspects as well. So this chart here I have on the Bitcoin daily right now has been drawn up this way for over a year now. And the spring, which was right here, was highlighted by the start of the pandemic. It was the most fearful moment that the markets have seen, at least in my lifetime. Every day after that moment, the spring led into the bull market. Now, this is actually pretty much around the table, how things kind of seemingly work. So even if we go to the S&P 500, what's really unique is that the previous trading range in the S&P 500, because again, you can do retrospective studies and you can learn a lot about what's happened by looking at the past. You can see two very clear moments here. So here, the green range for the S&P 500 on the 3-day now is what we'll show, is going to be, you had your buying climax, your secondary test, your first automatic rally, your spring. Now the spring was represented by July 2000 or September 2008, 2009. This was when the financial crisis occurred. Every moment from every day onwards from that moment would have been a great time to buy into the stock market. Now, interestingly enough, back here on September 11th, 2001, effectively as well, you have a very similar moment, which the spring is, or these massively characterized secondary tests or springs are actually moments in human history that are very fearful moments. Baron von Rothschild said, "Buy when there's blood in the streets." And this is to be noted because this particular moment in history, when the spring happens, everyone can see it. You don't need a chart to look at it, right? So as we get closer, here was the spring, at least for this particular widening megaphone pattern, on the S&P 500. Now, again, every day onwards from May 11th, we've been in a bull market effectively. So when we're looking at Bitcoin, one of the important parts to understand is that accumulation and what we're looking at right now on the 6 hour for reaccumulation effectively are almost vastly different, right? It took over, at the very least, it took around 600 days for the first trading range to occur. And the much larger trading range, the entirety of Bitcoin here, was around 1100 days. And this is where you have a big area of accumulation and then a big area of distribution. So I've been saying for quite some time that I thought that this was the midway of the bull market, that you would see one final leg up and then it would come collapsing back down to retest lows. Now, we've seen things like this happen a few times before, and I still believe we're in a bull market, even though we have some some leading indicators, like you could call it a hypodermic top, like this, which is a very bearish signal. It's actually the time that this longer accumulation took place that gives me any type of, let's say, forward-thinking mentality about where we are in the markets. But the spring is usually categorized, especially when it's very useful to you, is categorized by these heavy moments of fear. Now, right now, in this particular smaller time frame on the bull market, people are getting all excited about this spring. Now, there's a lot to be learned from these moments. Primarily, look at the amount of supply signature that came in. The spring, which we think is here, was akin to that of the primary shakeout. We've talked about this many times, the volume and the supply signature's importance with these trading ranges. So it does appear that we got a nice spring. There's a massive amount of candle wick into that spring that again leads us to believe that, okay, this was probably the spring in this area here. Now, right now, especially on the 6 hour, you can see that we're butting up and cuddling into some very strong areas on the 6 hour chart for Bitcoin. So we've broken out of our falling wedge. Now, I want to go over two things. So this one here, this is a schematic 4. This is what I think we've been kind of witnessing with a few variations. Remember, this is like finding an animal's footprint out in the wild. It does vary wildly. So this phase C spring is actually what I think we're witnessing, which is a falling wedge spring, even though we did have this kind of much larger automatic rally or up thrust test of the top of the trading range. Now, we're in key areas right now. We're above the falling trend line of the falling wedge, super powerful. And now we're starting to close above the point of control, this red line that moves all the way across my screen here. The point of control, or the POC, is verified or created by the amount of buying and selling pressure that takes place. So as we've gone over for the last, again, month, basically anything below the point of control here, with this, again, this large red line, was a good entry effectively. And this is how a lot of the bigger players play. They just look for entries below the point of control. Here you had Michael Saylor buying right on the point of control at around $36,000 to $37,000. So we know that this area is extremely important where I'm drawing the white line right now. So over the next few days, there's two things that can happen. And we've seen this before too, where falling wedges will actually spring downwards into the depth of the wedge before moving back up. So we have seen this characteristically. Like, again, we've been looking at charts for years now, and we have many times seen falling wedges that break above really quickly and then break down back below. That's why the other day when we saw the break out of this wedge, unless we could confirm above the green line, we knew we were going to come back down. So it's been a really beautiful, powerful trading range for anyone that's been jumping around in between it. That's not my style. I'm a long-term investor. I like venture capital. I love ideas like asymmetry and volatility through time. So what we're doing right now is just trying to focus on kind of the changes, right? We're at a hyper important moment in the bull market, probably right in the middle, at least up to my assertions. And then what we do next over the coming week is going to be very important. You know, what's interesting is that when we're down here, a lot of videos are bearish, and when we're up here, everyone's bullish, right? This is always one of the contraindicators to the crowd, right? Technically speaking, the moment to be the most bullish was the moment that the WHO declared a pandemic, because we went up every day afterwards from that moment onwards. So again, what's important to recognize is that this is fear. This is greed in the markets that has nothing to do with the price. Like, the pandemic had nothing to do with the price. So when we're now watching these moments and we see more greed come into the markets as we go up, one of the important parts to remember is that, yes, buying below the point of control is where you want to make your entries. If we are still in the bull market, even if we aren't in a bull market anymore and you're new as an investor, you should be focused on long-term accumulation strategies. They're just the best way to go. So now we'll go full screen here and we'll kind of finalize some of our thoughts here. Now, again, we're right up in a very important area. We could, if we start to jump above 38 and $42,000, the bull market is back in full swing. My condition here is that we have seen, again, these falling wedges jet back down to, well, that's a little low there, but we have seen them jet back down to the falling wedge area, which would be around 29,000 as a final spring before moving up. We've seen this lots of times, and this is what this looks like here. Now, again, any accumulation schematic is like a footprint in the wild. It changes. It's not, even though you're looking at the same animal, the footprint could actually look quite a bit different. That's why we have these different variations of schematics drawn up here at Arcane Bears. We love this Wyckoff stuff. I think it's fantastic. I want you to Wyckoff. I think everybody should be studying this stuff. It's so powerful. So I'm glad a lot of more people are. And now what's interesting is you also start to get self-fulfilling prophecies, where because everybody's looking at the same thing, everyone starts to make the same assessment, and then you see that picture kind of play out. Now, the Wyckoff method has been around since the 1930s, and people are just catching on to it now. So it's likely that it will come up and it'll catch all the hype, and then as the bull market ends, people will forget about it, because it takes 1,200 days for a real accumulation phase to take place. It's not like we're so lucky to be able to practice within these 47-day time frames practicing what accumulation looks like. So really, really fun to keep an eye on. Again, a key area where we're at right now is right at the point of control. If we start to close significantly above 37,000, we could just start the bull market right away. Now, there are two two qualities of things that are disconcerting. So for the downside, number one, the law of effort versus result is a very important part of Wyckoff's methodology. It's understanding that the amount of supply and the price spread that comes from that supply coming into the market is hyper important. So back here in June, we actually saw a nice price spread, which is represented by the amount of volume to the up, or the amount of price to the upside, and the amount of supply that it took to get there. Very limited. Here, we have a fair amount of supply coming into the market and a fairly limited price spread. This is actually a bearish signal, which is one of the other reasons why it would lead me to believe we get another spring downwards, probably maybe even here, effectively, where we turn around. So both of these supply signatures showed more result from limited effort. Here, we're seeing less result from more effort, the amount of supply signature buying at the moment on the 6 hour. So again, this is not, it's too small of a time frame. We do love the days where you have 1,200 days of accumulation, but this is where we are. So we have to make do with what we have and learn what's going on. So I definitely think that we're going to see a change over here. Now, for those of you that are kind of interested in some of the other fun parts of the story, we have a private member group. And one of our favorites, I'll show you this. This is, now you can see it here. Yes, a Wyckoff. I thought you guys would enjoy that. But let's go back here to our trading ranges. Yes, perfect. Okay. So fundamentally speaking, everything looks good. It is we are seeing limited result in the supply signature right now, which would lead me to believe we get another stroke of downside. Another thing a lot of YouTubers are not looking at, or a lot of other analysis are not looking at, is redistribution. So there's the evil cousin to reaccumulation is redistribution. Now I don't think I have this saved on my computer right now, and we haven't finished them, so I'm gonna quickly look it up here. None of these are drawn really well. That's great. Fair enough. Let's see if we'll get it. So there's so there's a few here, right? I mean, you can find a lot of these schematics for free. There's some beautiful ones, both the reaccumulation. Again, here's the descending wedge we've been talking about. This is where cup and handles or head and shoulders. This is where you start to see the variations of the accumulation patterns. But what we want to go over is redistribution, which is kind of the evil cousin. Now, one of the fun parts here is that you have a scale invariant nature, right? So when we go to Bitcoin and we look in the daily time frame, you could make an argument that this is an identical format here, right? Where you had your upthrust here, and this was phase C, and right now we're in the last versions of the LPSY before we break down and come even lower. So again, I don't like to take too much time to draw these because I've been doing it for quite some time now, so it's less important to me. For those of you that are new, I highly suggest you draw in all the points of the Wyckoff events. We're just we're like a little bit ahead of most people on this particular conversation of study, so these half-assed drawn lines to me are perfectly fine. I know what I'm looking for. I see a massive amount of selling climax come in, but again, knowing that we are temporarily in what I again believe to be the middle of the bull market, we can start to say, okay, well, this is actually the trading range, right? And you see these much larger stories taking place where you've got your PSY down at the bottom here, and then your buying climax, your upthrust, your last point of supply, and then again, this could be the finality of the bull market. Now, that's why we're so interested in these next movements here, is because we're always learning and we can get it wrong, like clearly, right? One of the reasons why this is such an important part of the conversation is right now we're either at the tail end or right in the middle of the bull market. The best time to show up was in March, when we could clearly see that the bull market was about to start. Getting in this late, you have to revert back to your investor cap and just go, okay, here's a valuable asset. I'm going to accumulate it specifically and consistently over time and not really think too much about the price. But in the meantime, what we can do is use this as a hyper powerful moment for education and learning, right? So that these falling wedges, even though they can become redistribution, they're not as powerful or as reliable as what it took to get here, because what it took to get here was months and years of accumulation effectively. So I think far too many people make the mistake there of not knowing what their strategy is in the markets effectively. So that's a really, really important way to go. The next thing I wanted to go over here was the actual balance on exchanges for Bitcoin. Our leading North Star guiding light for this rest of the sector. We've seen a constant decrease over the last few days. This is nice. It's good to see. We've been in like almost a trading range for the amount of supply in the markets, and it seems to be decreasing. If we start to decrease even lower than 13.68%, I think that would be a big bullish signal. On the fear and greed charts, we are still pretty much exactly the same. We are shoved right down near the bottom. Currently today, we are sitting around 25. We had extreme fear last week at 10. And this is, again, just a way to kind of ignore the price and focus on the sentiment, right? Again, if we know that the bull market started very specifically the day everyone was scared crapless by a new virus or whatever, then this is a great way to kind of look at that data and really kind of come to a conclusion. Now, the other part that's interesting here too is the hash rate. We saw a massive drop as miners started to leave China, and we're seeing some of them come back online, which is good. It's nice to see this transition. It's nice to know that Bitcoin shows at least robust and anti-fragile like behavior in kind of the midst of all of this. You know, we're constantly changing and evolving in this sector, and one of the things you like to see is can it make it through the shocks? Does the thesis take the bumps and bruises and actually show up stronger? And currently that seems to be the case. Very nice to see. Again, look at the dramatic drop off here from our all-time highs of the hash rate back to where we are. It'll be interesting to see how low it goes before kind of mellowing out. It seems a lot of Bitcoin miners are moving themselves around the world and trying out new places. So back to Glassnode, there's a few more valuable data pieces we've gone over. First off, the stock to flow model has been a huge reason why we didn't think that this bull market was over, just taking a breather. I said many times that I think that what we're about to witness is probably a 1 to 2 month period that just is designed to bore the average investor and go, oh my God, I've lost a little bit of money. I bought Bitcoin at 50 grand and now it's at 30 grand. Maybe I should sell it and buy it back at 25 grand because it's going lower. And that's where all the early investors make big mistakes. And that's how a lot of the big investors capitalize off your mistakes. Just because you buy high and then sell low. So don't do that. And then this is why we go over as much analytical, logical data as possible to make informed decisions based off what we believe to be taking place right now. So remember, the early stage new investors disease comes from over emotional trading and lack of understanding. And one of the best ways to cure that is by joining a group of informative people that know what they're doing and have been here for a long time. So why not try out our private mastermind group by going to the links down below and joining arcanebear.com/private. There's no risk. If you sign up, you're not happy, we'll give you an instant refund. But anyways, the stock to flow model here gives us that analytical, logical data content to go, hey, wait, you know, we've watched this cycle before. We've seen the cost of mining shoot up and then the price of Bitcoin drop down compared to the cost of mining. And that's what the stock to flow model represents. We are likely taking a breather. Now, again, in early 2017, we stayed well below the stock to flow model for quite a few months. Here, we actually broke up into it a little early. You could say that this bull market got a little too heated, a little too quickly, potentially. And we could make the assumption that we have the rest of January 2020 and through 2023 to kind of mellow out and find a new relationship with this $100,000 mark, which could be December 2nd, 2021, up at around $100,000. That's a very, very real sentiment. We could go from here where we are today up to 100,000. Now, again, that's understanding the course that yes, the Bitcoin bull market could be over temporarily, but if we have any hint of taking a past to future event time frame, we do see that the repeating nature of keeping the Bitcoin mining business going has actually been a pretty solid indicator. So things look great here. A lot of people are talking about the Puel multiples. We go over stuff like that quite frequently. So it's not the greatest indicator in my mind. I actually prefer the reserve risk ratio. So here's the Puel multiple over the last bunch of years. And anytime Bitcoin's price was in the green, that was basically a good time to accumulate. Technically, I agree with the sentiment, although you're still looking at a much higher risk to reward relationship, but it's actually pretty damn close. So I think the RR is a better measure. The Puel multiple is not as functional in my opinion, but what does my opinion mean? I don't know. Do your own homework. So the RR right now is we're actually pretty damn close to an accumulation area. And we saw that both when we looked at our stock to flow deflection model as well, which is, I think, more of a minor capitulation moment. Here we can see right now the stock to flow deflection. Anytime you're in the green, it's actually cheaper to buy Bitcoin than it is to mine it. And anytime that we're in the red, it's more expensive to buy it than it is to mine it. So the opposite. So anytime we're in the red, we usually get a lot of selling from miners, pushing the price down to take profits. And then anytime you're in the green, you can actually buy a Bitcoin for cheaper than what it costs to produce to mine it. And that usually represents the moment when the miners are just accumulating. So you have this kind of inverse correlation to the miners. And every year that we get further and closer to new halvenings of the Bitcoin price or the deflationary model that it runs, it becomes clearer that the amount of accumulation and distribution that takes place from the miners is obviously decreasing as well. So we're actually at a fairly historically low moment of the stock to flow deflection. And this in the reserved risk ratio to me is a clearer signal than the Puel multiple. But again, it's just my own conjecture. Now, we can take a few other ideas just while we're here right now. The Grayscale holdings, it's always interesting to see. These are some of the world's largest players. And as you can see, they've actually been selling Bitcoin every day since February, basically. So they've been on a constant sell strategy. So back in February, they had approximately 640,000 Bitcoin. Then all of a sudden, they jumped up and bought another 10,000 worth of Bitcoin in a very short period of time. So actually we can even measure this out a little bit further to look at the data here. Boom, boom. So back on January 18th, they had 600,000 Bitcoin. They bought another 50,000, and they've been selling that down by around 100 Bitcoin per day. This is how big players play. They buy a shit ton all at once, and then they slowly distribute over time. Again, almost every day they've been selling around about 100 Bitcoin into the open market to not affect the general price, but also to reduce their holdings because they're effectively up. You know, they bought that same 50,000 Bitcoin at around 30 to 40 grand. So they're mostly in profit for that buy, around 32,000. So anything they're selling today, they're selling in profit, even if it's only slightly in profit. So there's a few others, like you've got hodl waves I like too, but I try to keep things as simple as possible and remove more data. And the hodl waves and some of these others can add a bit of noise, but I do really like the reserve risk ratio. Our hodl ratio is another similar type of signal, but I think just to clarify, I prefer the reserve risk if we're gonna go over that. So again, here the best time back, at least for the R hodl ratios, was back in 2019, so it doesn't really give you that much opportunity. And as you can see here, we haven't peaked out. This is one of the other reasons, both on the R hodl, on the reserve risk, there's multiple signals right now that says we're about halfway through this market. We have not peaked out into the risk or the R hodl ratio here either. Again, with the reserve risk, you look at all-time data. What we're doing is seeing that we have not peaked out into the amount of risk for owning this asset. And more specifically, we actually see that we're quite close to almost a riskless entry. Anything in this green here, we can assume is basically a riskless entry. And we're right near that. If we were to go down to $20,000 Bitcoin, you're basically at a zero risk entry point for Bitcoin itself. So this is really important to understand. The big players are measuring more of their long-term investments based off stuff like the RR ratio or any time you're balancing risk and reward effectively, right? Like, do I do this thing or this thing? What's the positive upside versus the potential downside? Any time you are making a choice in life, you can use kind of risk ratios to balance that out. Now, sometimes it's hard to tell, but more importantly, we do have this really nice data. So we'll jump back in. What's the point of going over all this? All of the on-chain metrics still look bullish to me. They still signal that we are about exactly halfway through this bull market. Now we can go over and we'll start with the traditional market and we will end with the rest of our digital alternative assets. Actually, while we're here too, probably just because it's somewhat time sensitive, Solrise Finance is launching on the FTX IEO today. And if you have not yet check that out. Check out the Radium launch too. I'm a big fan of early seed stage type stuff. I love these launches. I mitigate my risk by going heads I win, tails I only lose a little. On the shorter time frames, getting into these what used to be ICOs like Chainlink was risky, but there are amazing technological movements taking place right now, and I think Solrise is one of those. So keep an eye on that. But back to the volatility index here. This is a really important factor. I think a lot of people overlook this, but because we're measuring general sentiment of human emotion all the time, one of the things we always want to keep aware of is what's going on inside of the human emotion and the human psyche. And we've actually been on this descending channel for the volatility index for a few months now, which is great. People are getting more and more used to the pandemic. They're getting closer and closer to the idea that we will recover, how we will recover, early patient outcare. I'll just drop that in there. Hint, secret. Check out Brett Weinstein, Joe Rogan, and Lex Friedman. Probably deserves a whole video, which we'll give that later. But this descending volatility channel is very, very nice to see. We're actually getting back kind of to normality from 2019, just into actually our lowest point today is the highest point in volatility we had back to 2019. So by normal, I mean we're coming into some range of sensibility, which I think will allow us to all think a little bit more clearly about the decisions we've made over the last few months, which is hyper important. This is really interesting to see too. So you'll know that our conjecture around the NASDAQ, and again, thank you for the person who pointed out that I was not charting the ICX, which is the composite index. I was charting NASDAQ for a few days. That was my bad. We've actually broken out through the top. Now, again, we could be witnessing what turns into a rounded top, but I'm still standing by my market melt up theory. I think that every day after 2008, we've just gone into a moment where there's no other choice but to print money. And because of that, we're going to see an involuntary association of prices in the general stock market to go up. I call it the great market melt up. Since 2016, that's been my assertion, and every day further, we have concluded that that is the correct assertion to have made, which is that these markets are going to go up based off the monetary supply. So one of the things I think that's, again, really important to understand for people is price and value are kind of a hallucination. So what we're going to do right now is we're going to compare the monetary supply to the NASDAQ composite. So what's interesting here is that you see a direct correlation, especially when we get it locked in. Boom, there it is. So basically, since 2001, the orange is the amount of printing or currency supply that they have allowed onto the open market, and has continued basically rise almost ephemerally or systematically, especially when we get it right there. Boom. So M2 monetary supply in orange and the growth of the NASDAQ composite here. You can see that they're almost identical. Like they move in lockstep together to the point where when you get, boom, there he is. When you get it just right, it becomes blatantly obvious that the only reason the markets are going up is because of this monetary inflation. Now, one of the difficult parts here to know is that technology is inherently deflationary. The fact that I'm able to produce a YouTube video and communicate with you guys is an inherently deflationary process. So just like with the S&P 500 and the NASDAQ, when we overlay the composite M2 index, and we can see that the markets have basically been moving up in lockstep with the amount of money that they've been printing. We have to assume two things. Number one, they can't stop printing. If they did, this whole market collapse and nobody would start working for each other and everything would go haywire real fast. One of the big downsides to where we are right now is the fact that if they don't keep it up, the addiction to the monetary stimulus that we have right now is so incredibly high, nobody would start to work anymore. And we're actually even seeing kind of side effects of that, where people are like, I get paid more money by sitting at home on a stimulus check, so I'm not going to take a job somewhere as a waiter, right? They might get paid more to be on unemployment insurance. So we've been watching this trading range in the S&P 500 and the NASDAQ kind of evolve, because it's somewhat clear that we're moving into the finality of a trading range. And we've seen these trading ranges actually break to the upside and just go absolutely ballistic. And I think that that's probably what's going to happen for the S&P 500. I don't think that they can factor in a stock market crash without absolutely destroying the entire world's economy. And that wouldn't be a good thing. That would mean that basically no one was working. I don't think we can actually handle that. It might be better to just try to print money. Now, I'm not an inflationist. I love Bitcoin for this particular reason. We need to have control over the monetary supply. We need to know what it's doing, and it should be transparent the whole time. But with the rest of the stock market and inflation in all of these different assets, I still am under the impression that we're going to see a stock market melt up. So keeping a really close eye on this, because this very, very quickly could turn into an upthrust after distribution, and you could see the same thing happen in the S&P 500 that just happened in Bitcoin, and we could break down lower. Now, again, I'm kind of leaning against that from my own personal philosophy, that if they did it, it would just destroy the markets. But hey, what do I know? I'm not in charge of printing the money. So lastly, the DXY, or the dollar index, is another one we want to take a look at here, just to kind of override the process that crypto is this in a bubble. Well, first off, by a bubble like in its own little world. But the dollar has actually been gaining a lot of strength through this market turmoil for no particular freaking reason. I have no idea why anyone would assume that the dollar has strength. Like, it's not like their leader is super strong or any of their policies are super productive. Again, what the fuck do I know? I'm not a politician, and thank God for that. So the strength here in the dollar index is a hallucination based off the idea that people think that the US dollar still has value. When we do go out to the larger time frame, we see something very unique, is that, and even though we don't have a shit ton of data on the dollar, there's reason to believe that we're going to continue in this long-term downtrend that we've been seeing for the last, 35 years. So here's the last 35 years of data, and we've been in this kind of consistent downtrend. You know, we can make an argument that right now we're actually witnessing a larger trading range, something like this. And that one of two things are going to happen: that this was your upthrust, and now we're in the LPSY phase for the dollar before we break down, or that this was the spring. Now, we don't have any volume indications to tell us what the fuck is going on in the US dollar. So this is likely the trading range that we're going to be wanting to watch for the next little while. If we break down here, it's probably very good for Bitcoin. If the dollar starts to jump up for some crazy reason and manages to break above 104, which I don't see happening, it could be, again, destructive towards the markets. I don't think the Fed is going to let that happen. Again, since 2016, I've stood by this market melt-up scenario, and we've been right, like more right than I thought, because this was way back here. People were calling for a huge correction. All the YouTubers in the financial sector were like, oh my God, we're too high. This is unsustainable. And I was one of the few, not that I'm trying to toot my horn. I mean, I was making ridiculous, outlandish predictions. The fact that I was right, you could just say I got lucky. It's not like, oh, I actually got right. Now, I could have just gotten lucky, but we got it right by being lucky. We've had this consistent market melt up since 2016, and it's been astronomical. Like, it's a lot of growth in the NASDAQ, so be aware of that. Over our other favorites, nice to see Ethereum have a little bit of recovery here. Again, this does not look great. For both of these, you could easily declare that this was a hypodermic top for Ethereum too. So we're going to want to keep our eyes on it, although we're seeing a lot of accumulation of Ethereum and getting it locked up in its proof of stake protocols effectively. So we could be seeing a floor put in here, but remember, Ethereum was $80 just a year ago. So from $80 to $2,000 is a pretty big change. So just something to keep in mind. Big fan of Avalanche. I definitely kind of didn't see this one coming. This is one I definitely got wrong. I thought we had a beautiful spring for reaccumulation after decline here, and we just got annihilated on that one. So I was definitely wrong on Avalanche. Solana, luckily, we were a little bit faster to get out of. Pretty much right along the same time we got out of Bitcoin. I closed out a few of my positions, not all of them. Some I sat on, like my Serum play, I sat on like a 6-figure loss pretty quickly. But nonetheless, we're early here, I think. So as long as you are playing intelligently with your spot plays, you can survive all of this. It's just about long-term accumulation strategies. Heads I win, tails I only lose a little, or I guess even better yet, tails I don't lose that much, and heads I win. So we're trying to play with this philosophy and this mantra of trying to figure out where you were. Again, here we had a beautiful start of our trading range take place. We had an upthrust that we thought was going to turn into an SOS, and it very quickly slammed us back down. So now we get to witness what the rest of the trading range is doing. This is one of the interesting parts, is that we've got this beautiful study that's taking place on a day-over-day basis that's teaching us new things. Now, this looks like potential distribution to me. Like, we could go lower, but there's not a whole lot more room for downside on a bunch of these. Not a whole lot more room for downside on 1 inch, right? So it's very interesting to see how these will react over the coming month, because there's a lot more room for upside than there is for downside in any of these plays. They're all asymmetric bets. So remember, tails I don't lose much, heads I win. That's such an important mantra for everything that we go over to study. So anyways, we're gonna leave it at that. Mark, again, has been doing really well, keeping its stablecoin value. It didn't do a Titan, and it didn't do one of those other stupid stablecoins. So as long as they don't break this thing, I think they've done a great job. We need more algorithmic stablecoins, I think, that are backed by the supply and the currency demand effectively. So I hope Mark does really well here. So far, so good. It does look like they're reducing the volatility every day moving forward, and you're getting closer and closer to a really well-priced and pegged stablecoin. So congrats to them. I think that's super cool. And then FTT, again, remember guys, one of the reasons why we're big fans of FTT and FTX in general is we just believe that there's so much power in the growth of a community. We like Sam. We like what FTX has built. And we think that they provide a really unique product for the rest of the ecosystem. So keep an eye on that. Again, this is where it does look disturbing, is that as soon as we broke our trend line on that we were following for FTT here, we did break down quite quickly. Had a very harsh, dramatic trend line. And again, there's a lot of indication that these are actually distributional moments. So definitely keep an eye on Bitcoin. This is the last final moment of phase C here. It'll quickly turn either way. And again, there's not a whole lot of room for downside in 1 inch, but when we look at FTT, we see, okay, well, shit. In December, when we were first started going over these tokens, we are still up 600%, right? So if you go to arcanebear.com right now, you can take a look at a lot of what we've been studying for the last 9 to 12 months. And one of our favorite things to do is provide a lot of free value for each of you guys. So our new research page of everything we're interested in, from WooTrade to FTX, you can go in here. You can look at the FTX token. And this information will always be free, although some of it will start to be paywalled, like distribution times, etc. I don't know why Mercurial, we added Mercurial in here to the FTX. We'll have to fix that. But again, the important part here is when was this written? May 13th, 2019. Good work. Very early. Take a look at the prices that were going on back there. Wait, hold on. That's totally incorrect. That's totally incorrect. This was a duplicate page. Otherwise, there's no way we wrote this about FTX on May 13th. So keep that in mind. It was much closer to like May 2020. Much closer. Anyways, do more research. We think it's hyper important. We continue to try to expand that research. Again, we started to grow at our Wu Wei side of things as well. So some of these companies don't even have tokens yet, like Pods Finance or Maple Finance, which we'll have on the show, Insurace. These are all us diving further and deeper into the venture capital aspects of DeFi. We think it's absolutely wonderful. It's the most exciting. It's also been the most lucrative and productive to find things like Chainlink right out of the ICO. Now, I got that one wrong, but now the guy who got it right works with us and collaborates with us on managing it, because I'm not a tech guy. I couldn't tell why Chainlink was going to be such a great idea, but clearly other people could. So that's why we started to really up our research game. And again, if you guys are interested, we'd have a large swath of ideas that we've started to go over and research. Energy, Cardano, 1 inch, Theta, Synthetic, Sushi. These are all free, available from DHedge as well. You can dive in there, do your research, and also sign up for our free newsletter. By going to arcanebear.com, we are producing a free newsletter. So now that we've kind of scaled up, I'm back working. We've got a few more things coming to the table. So when you go to arcanebear.com, you'll get prompted to sign up for our free newsletter as well. Do that. For those of you in the private group, you will get your monthly update in the next few days. I apologize for some of the backlog work there. Oh, shoot. Close that. Anyways, boom. There we go. It's T with the Arcane Bear. Thank you all for joining us. I did see someone left a super chat. It says, Papa Bear feeling bullish. Nice. Thank you for that, Danny. I really appreciate all your guys' support. I have a lot of fun doing these videos. So if you're new to the family, subscribe, hit the little notification bell, give us a thumbs up, do all those fun things that you like to do. And yeah, we'll see you guys again on the next episode, the next update. Maybe we'll even go live this evening just to see where we are in this trading range, because I think it's going to change probably quite quickly. Anyways, we'll see you guys in the next episode.